Good afternoon, everyone, and welcome to our webinar today on material ESG risks for the insurance sector. Just to give you a little bit of background about the webinar and why we're doing this webinar is being organized by the Malaysian Sustainable Finance Initiative, and which is a center of excellence under Capital Markets Malaysia. Today's webinar is specifically designed for insurance sector and takaful sector participants who are looking at ESG risks within the sector. So we've got, it's a 90-minute session today, and we've got a great lineup. We start with a presentation by EY, and then we've got 3 presentations led by Wolfram Hedrick from EY Singapore, Junaid Iqbal from AIA Malaysia, and Marcel Omar Pap from Swiss Re Malaysia. So before I introduce the first speaker, just a couple of housekeeping rules. Because there are so many participants on the program, we'd like for you to drop any questions you have in the Q&A box. So you can see the Q&A box at the bottom of your screen. Just have to click on that and type in your questions, and the moderator will feed it to one of the speakers during the panel discussion. So without further ado, I'd like to welcome Arina Kok. Arina is partner, Malaysian Assurance Climate Change and Sustainability Services Leader for EY Malaysia. Arina will lead the first presentation and moderate the panel discussion. So Arina, over to you.
Thank you, Navina. So I think the first part we are going through is a quick 20 minutes sharing session to kickstart and set the scene before we go into a sharing session by Junaid, Wolfram, as well as Marcel. So the first part is we want to talk about what are the main ESG risks faced by the insurance industry. So if we talk about the decoding of ESG, just a quick recap for everyone who's fairly familiar with the ESG concept. The environmental factors really covers the impact on living organisms, non-living elements, including air, land, water, and ecosystem. When it comes to the social factors, it does cover individuals and groups such as communities, vulnerable groups of society. For governance factors, it covers structure, governance structure, composition, knowledge, roles, and remuneration. Now, when we talk about ESG issues, we are seeing quite a number. Our organizations are managing the impact on their ESG issues, specifically not just from existing risk classes, and also the firm's risk profile as required, and we are seeing a push by regulators. Two of the key prominent risk areas are really very much focused within the insurance sector is also on physical and transitional climate change risk. If we look at how this impacts financial institutions, you can see that once the external risks are identified, this is typically in the form of various aspects: operational, credit, litigations, compensation, so on and so forth. We are also seeing that this is also connected to the external ESG risk view. So there is an internal and external factors when contextualizing the risk consideration. On external factors, it is really the impact of the firm's business operations and how that impact the external as required. So the considerations of where typically we look for as an external party is to look at also how this ESG are being monitored by regulators. So there are discussions, heavy discussions ongoing on not just data, technology management, employee satisfaction, but how the broader impact of ESG and climate change risk are affecting the ecosystem and how the insurance sectors are operating. So at the part, you can see that the communication for internal and external have been navigated external through the sustainability risk reporting typically, or various other channels, external channels. But for internal, it's very much through the enterprise risk management framework, which is now being enhanced and extended to cover ESG beyond other existing risks as well. So when it comes to climate change and sustainability, the issue when it comes for insurance sector is really beyond the massive societal threat posed by climate change. If you see on the left box in gray, insurers have multiple reasons to act. First is really by no choice, regulatory pressures, negative impact on own bottom lines and stock prices, as we'll cover in the next slide, restricted future access to capital. You can see that quite a number of insurers, if you see this box at the right bottom, is 50 out of 66 insurers in the MSCI World Index have been excluded from the World SRI Index due to low ESG ratings. So we are seeing a common trend of the assessment of insurers, and there is a need for them to ramp up. Otherwise, there are restricted future access to capital that we are also envisaging and seeing. Reporting regimes, underwriting policies, as well as customer and employee expectations. So for today, we are seeing, however, the leading insurers are taking quite tangible steps to adopt hard metrics as they seek to actually address a fuller range of ESG issues and opportunities. So where they are taking is to relook back at not just operations, but also the entire insurance value chain. We have seen in terms of the current impact, climate-related losses will continue to get worse, but less than half of climate-related losses are typically insured. That's the current state that we're seeing. Consumers are really expressing their preference for doing business with greener companies, understanding what green means for insurance. And with both regulators and investors looking for deeper and more detailed metrics, insurers face a high bar for compliance. And as we see at the bottom, these are statistics that adds up to further why insurers plays a critical role. 36% is where climate-related economic losses that were insured by in FY 2020. 79% of global consumers who consider insurers' commitments to environmental issues in purchasing decisions, there is consideration. And when it comes to the source of high or significant stakeholders, pressure on sustainability, we can see 48% from legislator, 27% from investors, and 26% from rating agencies. So this is actually from the best survey of senior insurance executive survey. Now, when we look at the next slide, in terms of contextualizing why insurance plays a critical role, this slides actually outline from the Aeon catastrophe insight. We can see that given the cumulative insured losses period, we have seen a significant rise, not just from insured losses, but also the number of count of billion-dollar events. So if we see the key takeaway point is economic losses from natural disasters have been estimated at $343 billion in 2021, with a global insured loss of $133 billion. And that is really to outline the gap of insurance that we're seeing. So the number of disasters and the economic loss versus the insured loss, you can see from the significant event that we've outlined here, just for context and example, the Hurricane Ida, the winter weather, as well as the flooding in the Western and Central rural, we have seen the amount of insured losses fall short when it comes to the economic losses, most of the time below 50% of what the significant losses have reported. So if we look at that from a context of ecosystem, this is where within our barometer that we've issued, the transmission of context from a natural disaster to financial sector losses, you can see that when it comes to climate-linked natural disaster, regardless of whether it's insured or uninsured, there are systemic risks that trickles into the impact towards insurance as well as financial ecosystem. So for those we're seeing here is definitely when we see for those insured is also considering the risk from the damage, the asset sold in fire sale, whether it's from the transition risk, the carbon pricing, or if you trickle down, the yellow lines are direct impact, the ones in the gray are indirect impact. So we will see things like increase in market uncertainty for loss of investors' confidence, direct damage, and that is where reduction of insurance in affected areas, fall in collateral values, weakening of household and corporate balance sheets, and limited financing available for reconstruction from physical damage. So these are the various impact when you look at the whole ecosystem. But when it comes to what leading insurers are pivoting to the why and from the why to now the how execution, there are quite a number of solutions that we're seeing in the market. And when it comes to sustainability strategies, it is can be focused more on the purpose, which is to protect society from the most severe risk, profits, considering the growing of both the top and bottom line profitability, as well as the upside opportunities that are particularly compelling for insurers, really is to demonstrate visionary thinking and strong leadership. Now, which part we've outlined here is really focusing on priority areas that would benefit in terms of achieving underwriting policies that are effective, investment and portfolio management strategies within internal and external operations. When it comes to the reporting and disclosures, as this become more standardized, more transparent, companies will then be able to benefit from having easier access to capital, increase customer loyalty, and better share price performance. So proactive insurers are really seeing more creative and innovative solutions such as parametric policies and those featuring carbon offsets for the market that are heading towards that maturity direction. Some insurers and reinsurers are also playing a catalyzing role to mitigate and underwrite certain immature risks in ways that will allow the traditional capital providers to invest in areas that is enabling the transition. So where it is making the greatest impact within the sustainability and value chain are very much the capital investment, corporate infrastructure, corporate communication, and the human resource or leadership risk management. So some talked about what are the example of immature areas that are growing. It's really on some of the technologies that we're seeing as well. So for example, different sectors have different areas. So it could be the areas of the infrastructure for EVs or EV manufacturers. It could be also the carbon capture solutions, as well as what we're seeing more commonly being discussed. But in the long term, in different areas are hydrogen assets, and some are very much on agriculture, smart farming. All those things are new tech that will actually be considered when you look at project level assessment. So these are some of the areas moving towards when it comes to transition. In terms of areas to see the largest increases in impact in the next 2 years, number one is pricing, customer services, passive reinsurance, performance management, claims processing, and product development. So when we look at a bit more deep dive, insurers are really slowly developing new products to respond to climate change and servicing the new customer groups. So for parametric insurance, what we have seen is the insurance coverage is triggered by occurrence of events such as cyclones, floods, where the payout is based on predefined scheme and not actual damage. So Munich Re have offered parametric insurance against cyclones and earthquakes, and where the coverage is triggered by severity of catastrophe, crossing a predefined threshold, and generally provides parametric insurance to corporate clients, enabling business continuity in case of adverse climate event. So for pollution cleanup insurance, we see it's very much focused on coverage to protect excess cost associated with measures taken for cleaning up pollution at project sites. So AXA has offered ground pollution insurance, which protect organizations against excess costs incurred due to cleaning up of pollution at their project sites. Chubb provides coverage for clean tech sustainability suites to help clean tech technologies insure against costs incurred due to pollution cleanup, which is part of their RAND-D property as well. So for renewable energy insurance, it is to risk coverage to protect insurance needs for renewable energy companies, including wind farms and solar power stations. So Aviva offers specialized insurance package for renewable energies such as onshore wind farms and solar power to provide coverage across the life cycle of project, including coverage for incidents such as construction, third-party liability. Now, Chubb provides insurance to renewable and alternative energy industry across client groups, including geothermal facilities and biodiesel producers. For crop and forest insurance, the insurance coverage for forest or commercial plantations and crop production is to provide risk cover for losses against catastrophe events, such as fire, storm, drought, and excessive rainfall. So Swiss Re, as part of the example, they provide reinsurance solutions to commercial plantation owners, protecting against losses caused due to fire and storm, where the claim value is based on a predetermined timber value estimation. And for Munich Re offers crop reinsurance, such as multi-peril crop insurance, where the yield loss risk is to provide protection from drought, excess rainfall, frost, and windstorm. So these are just some of the examples that we've seen for some of these insurance groups that have been put out in the market. Now, when it comes to leading market, we are also seeing leading practice to embed ESG into existing risk categories rather than just product innovation. What we've seen is define group, the 6 considerations. The first is really to define the group ESG strategy, have a holistic framework established to identify and address specific sustainability risks across the entire business. And most commonly, this is supplemented further by sub-policy. So whether it has a sector-specific guidelines, that's where you go down to the granular detail. Identify risk categories for which ESG is relevant. Such as 2 things: analyze impact of sustainability risks for each existing risk category in the group risk policy, and consider whether certain types of business activities do not support the overall sustainability objectives of the group. So the third part is really to define methods and tools to assess and prioritize and respond to ESG risks. So most reinsurers have developed and implemented tools, typically combine vendor solutions and internal development, and approval process for screening sustainability risks in the risk management and underwriting process. The next one is also to establish risk as appetite with respect to ESG risks, taking into consideration severity, prioritization in the overall business context. So number 4 is to define the process controls, including KPIs, to monitor the risk. It is to also look at tools to obtain communication channel responsibility, and where are the escalation mechanisms. Now, this is really to provide timely, accurate, reliable communication to internal stakeholders. Number 5 is to define and manage the ESG risks. So this is where responding to risks to prioritize and to according to their key relevance, and assess if the responsibilities are clearly assigned, what are the adequacy of measures, and how this is verified and adapted. Lastly is to have a standardized reporting framework, integrating this into the group-wide risk management process, regular reporting, and have external reporting process with focus on accuracy, completeness, appropriateness, integrity, traceability of data and information. So when it comes to risks, what do insurers and Takaful operators face from climate change? The context on physical transition and liability risks we see here. The potential manifestation of risks to underwriting activities. Physical risk is very much the pricing risk arising from changing risk profiles to insured assets and property for non-life, changing mortality profiles and demographic trends like life and health. Considering the claims risk arising from confluence of extreme events, as well as strategic or market risk arising from changing market dynamics, such as uninsurability of property, and where the potential manifestation to investing activities are very much the impact of these events, climate events, and trends on assets, firm sectors, affecting profitability and cost of business, leading to impact on financial assets, portfolio, debt, equity, so on and so forth. So for transition risk, which is considered very much, for example, from carbon taxonomy, carbon tax, as example, the potential manifestation to underwriting is very much arising from contraction of market demand in certain sectors. We're also looking at strategic and market risks from trends, technological innovation, policy changes related to climate change affecting products and services demanded by consumers, such as, for example, if there is a certain ban on ICE vehicles, like how Singapore has rolled out and confirmed for 2040, those will change the market dynamics for the automotive sector. And when it comes to the investing activities, similar is going to also look at the impact to financial assets and portfolio. Now, liability risk relates to climate-related insurance claims due to failure to manage climate risk. So the focus is very much arising from insurance liable on the basis of insurance provided. So examples are tort or negligence claims. The other context is also stemming from directors and officers' responsibility. Whereas when it comes to investing activity, it is very much litigation such as class action relating to considerate climate change in investment decision-making or inadequate disclosure on climate risk. Yeah. So, sorry, the slide. Two more slides. Hold on, yeah. Okay, so when it comes to the approach to identify climate risks, related risks for the insurance sector, just a quick outline of the approach is really looking at liabilities and asset perspective. Liabilities is really from the more severe and frequent weather events, changing policyholders, and assets is very much how the assets are often long dated to match the duration of the liabilities related to insurance saving products and how they are exposed to credit risk. And in particular, real estate may also be exposed to weather events. So from the risk factor mapping to climate change factors, the research is typically focused on mapping the risk to transition and physical risk. So the risk factors for property and casualty are usually the natural catastrophe, flood, storm, earthquake. Geopolitical risks are, for example, the other aspects of terrorism. Man-made risks are liability, motors, so on and so forth. For life and health, as I mentioned, the mortality, morbidity, longevity, lapse, and the others are the economic risks and climate change. So when it comes to mapping of risk factors is to also look at the connectivity or underwriting exposure on property contracts, casualty contracts, special lines such as agriculture, credit and surety, marine and aviation or transport engineering. The other aspects are the life contracts, health contracts, and securitization. So the longer term risks, which is the reinsurance firms, they would apply forward-looking approach through the active monitoring or research, such as looking at emerging risks. What are the support for review of early signals? Whether it involves internal, external database, literature, subject matter experts, and they would also look at the ORSA processes, how organization could assess their long-term strategy as part of their ORSA. So the last slide I have here, in terms of the approach, typically you would see from these focus areas and where we have also outlined UNEPFI, how managing the ESG in non-life insurance business. We have outlined here the potential underwriting risks that has been done is really to have the heat maps, given the indication of the potential impact. How does it impact the certain lines of business? What are the possible dimensions of the heat map? Probability of certain risks materializing, as well as the potential impact of certain risks materializing. So in terms of the matrix, it is to establish and track the potential impact at portfolio or segment level, such as annual expected losses, average annual losses, and aggregate exceedance probabilities. And this all will then be seen at the bottom, an example of heat map by UNEP Principles for Sustainable Insurance, whereby they've defined the theme climate change, the risk criteria, air pollution, greenhouse gas. They talk about the risk mitigation examples and good practices, and they have also mapped out where this risk would manifest in the various economic sectors, be it whether it's energy, coal, healthcare, logistics, so on and so forth. So now with that, we are going to get into the next part, which is the sharing session. We have today just quick introduction before we get on to the discussion. We'll kickstart with Mr. Junaid Iqbal. His passion for sustainability stemmed from witnessing hypothetical climate stress scenarios turn into reality decades ahead of forecasts in his home country of Pakistan, where severe water shortages, extreme heat and rainfall have caused havoc. So it's a country that is 1/3 flooded right now, paying a heavy price for the world's lack of sustainable behavior. Junaid leads AIA Malaysia's sustainability function as Director of Sustainability and is a qualified actuary. So Junaid, over to you.
Okay, thanks, Arena, for the introduction, and hi, everyone. So as you heard, my home country, Pakistan, has seen devastating climate scenarios turn into reality. It's literally like doomsday. A third of the country is drowned underwater through like biblical levels of rain. So we're seeing like 700% of annual rainfall happen in a very short period of time, and all of the scenarios that you envision will happen if there's a flood, like migration and like rising loss ratios and insurance and viral diseases are all sort of panning out all within a month. It's quite horrific. So just to start on that note, perhaps Rina already covered the term ESG and what it means. Maybe I'll just add a little bit more. So this term goes back to about 2004, when a couple of financial institutions got together and presented a report called Who Cares Wins. So we've covered the E part and the G part in detail. Maybe on the S part, I can just add a little bit more. So the social element involves aspects such as human rights as well, and the impact of activities that an institution is having or making on its communities. Now, as most of you might be aware, Malaysia is an export economy, and as reliance on foreign labor has increased, so have complaints of abusive working conditions and living conditions as well. So in the past 2 years, about 7 Malaysian firms, including a leading glove manufacturer, have faced US import bans over labor conditions. So these things can't be ignored anymore, even when you're making investments. So ESG and sustainability broadly, the terms translate into meeting our own needs as an institution without compromising the ability of future generations to meet their own needs. And what this translates into is, having a healthy planet, healthy people in a business that's caring for the environment and the communities it serves. So AI has also built an ESG strategy, which is based on 5 pillars. The first pillar is health and wellness. The second one is sustainable operations, then sustainable investments, which is a major part of it. And then, people and culture and effective governance are the underlying foundation for these pillars. We have also committed to net zero emissions by 2050. And this is a credible goal because it's in line with the Science Based Targets initiative. So it applies the latest climate science to this goal and has governance checkpoints along the way on how we will reduce emissions over the next few years. So if I can dive a bit deeper into perhaps our risk governance. So the risk governance framework that we have is built on the 3 lines of defense model, which might be familiar to some of you. And it clearly defines roles and responsibilities for the management of risk between the executive management in the first line, so the risk takers. Then there's risk and compliance in the second line, and then internal audit in the third line of defense. The group and the business units place reliance on and work closely with their respective first line partners. So the risk function will work, with each first line risk owner, and they'll ensure that risks are anticipated and managed regardless of the ownership of any specific issue. So at the group level, what we have is that the board will retain the ultimate responsibility for the oversight of the group's risk management activities. And this will include the monitoring of risks such as ESG related risks, which of course includes climate related risks as well. The risk assessments that are carried out will flow into the respective committees. So we will have an operational risk committee and a financial risk committee, and sometimes there's another committee called the management risk management committee above it. So the risks will flow into that and then be shared with the group risk management committee on a frequent basis. So this may be quarterly for some entities. We also have an ESG committee in place at the group level, and this will see the oversight and the implementation of the ESG strategy that I mentioned. Now, the ESG strategy that is based on 5 pillars has defined metrics and targets for each and every pillar. So the ESG committee will also, give visibility on updates related to the metrics and targets, if any. Then we have an investment committee. So the investment committee will set and monitor relevant ESG criteria, as well as requirements, and then it'll establish controls and policies, and procedures around the investments that we make. The model is generally replicated across our markets, across different business units as well. So they will have their own local risk committees as well as ESG committees as well. So maybe if we can zoom in a little bit on the environmental part, particularly with a life insurance lens. Now, as you can imagine, on the life insurance side, the primary sort of focus is on the asset side, as Arina mentioned. And then, of course, there's a distant second, which is the liability side in terms of mortality and morbidity as well. There's an excellent resource that I'll reference here in the image that you see on the screen. So this is the CRO forum, which is comprised of insurers, and they've published a report called The Heat Is On a few years ago, which lists out some very nice direct and indirect impacts of climate change. So life insurers are exposed to climate change by way of both our in-force as well as our new business. And increased heat, as Arina also alluded to earlier, can cause actual health changes, which I'll just dive into shortly. So the direct impact that you see is the increase in the frequency and severity of weather events like floods and storms. And some of these have become very visible in Malaysia for most of us. Indirect impacts are things such as the rising incidence of diseases, volatility in water and food supplies, and even increases in air pollution. So then, of course, society can be impacted. For example, if there's a rise in diseases, it can impact the overall health infrastructure of the country that you're in. And as I mentioned earlier, this is something that I'm seeing in my home country following the massive flooding that has drowned 1/3 of the country just a few weeks ago. What we started seeing there is that hospitals suddenly saw a spike in admissions due to viral diseases such as dengue and malaria. And as access to clean drinking water reduced because of the flooding, and access to even dry land decreased, there was a rising incident of infant mortality as well, unfortunately. Weather changes can also, cause migration. So we've seen migration started happening from flood-prone areas to non-flood-prone areas as well, which causes disturbance in the population distribution across the country as well. Now, for a life insurer, basically, what this means is that this converges into impacts into your mortality, morbidity, and hence possible implications to the way you price your products in the future, and perhaps in the worst case scenario, even insurability. So in our group ESG report, we disclose such climate-related risks for life and health insurers. And similar to what Arina mentioned, we break them down into physical, transition, and liability risks. So physical risks such as extreme weather events can have a direct impact on AI's operations across the 18 markets that we operate in. For example, our branches could be impacted by severe flooding, and then hence controls can be developed accordingly. So for example, if access to our branches is restricted, then controls need to be in place on whether services can be provided in an electronic form, or does that mean that you actually have to relocate your branches to an area that's less flood prone. Transition risks can occur when moving to a less polluting sort of greener economy in the future. And this could mean that some sectors of the economy could face very large shifts in asset values or higher costs of doing business, which could impact the asset side for us as well. We could also face changing consumer preferences, and what that could result in is possible, perhaps future exposure to litigation as well on the liability risk side. Liability risk is something that was a little difficult to understand for me, but there's a very good example from the Bank of England, which illustrates it really well. So they say that, suppose investors back a business which goes on to make a very large loss due to climate-related events. There may then be a question by investors on whether the business had provided enough information about its exposure to these climate-related risks. So if investors felt that this information had not been provided, there may actually be a claim against the business that they did not do enough to do relevant disclosures. I won't go into detail on the transmission channels, but we also in our group ESG report, we show the links between the vulnerability factors and the different exposure pathways and how these are sort of interconnected and can result in, the health system overload, for example. So just on the health side quickly, before I conclude, there's some evidence emerging, although data remains quite scant, as you probably hear from the reinsurers as well, that climate change is actually can increase the risk of illness through both increasing temperatures as well as rising air pollution. So you can what is expected is perhaps a rise in incidence in gastrointestinal illnesses, effects on the body's nervous system, respiratory systems, or even liver and kidney damage. There's research emerging that actually links pollution to a rise in incidence of non-smoker cancers. So there's a couple of researchers who, from Hong Kong and UK, who study long-term exposure to a mixture of environmental pollutants that come from transport as well as power generation. And their study actually showed that for every sort of unit increase or 10 micrograms increase in pollution, there was a double-digit increase in the incidence of death from cancers associated with a rise in pollution. There's a few potential explanations that they've shared, such as pollution might spark defects in DNA repair functions, and then alterations in the body's immune response, or inflammation that triggers gastrointestinal issues as well. On the mortality side, there's actually an interesting paper by an author named Jasperini, who's linked mortality changes to the extreme climate scenarios, which are called the representative concentration pathways. So in the extreme scenarios, he's sort of suggesting that there could be an excess mortality of 2.7% in the next 3 decades and about 12.7% by the end of the century. So data remains scant, but it's not looking great. So perhaps with that slide, I can just pass back to Arina, and happy to hear thoughts later if there's any.
Thank you, Junaid. That was a good sharing presentation. So at this point, I would also like to invite Wolfram, our Asia Pac. Maybe we can have the slides up. So Wolfram is our Singapore-based EY partner within the Financial Services division. He runs the ASEAN Business Consulting offering and lead the APAC Sustainable Finance practice. He has spent most of his professional career advising banks and other financial institutions to improve risk management practices, closely linked to risk, finance, and strategy. So one focus is really to integrate climate and sustainability aspects into risk management processes. Over to you, Wolfram.
Thank you, Arina. And I'll pick up directly where Junaid ended up, and that is the scarcity of data and information, right? Because what we have seen in the last few pages that Junaid shared is that the logical transmission between kind of the effects of climate change on kind of the physical impact on the human condition, if you will, we can still follow that, right? And there's an slowly emerging and building body of scientific work to show that. The challenge, and that leads me to my topic here, is if we're asked to actually quantify this, and quantify this not in just one general terms, but in different scenarios. And that leads us to the topic of climate risk stress testing. Now, we're going a little bit from the broad ESG topic now to a more specific element of that. So we're closing in on the E part of ESG, and within the environmental part, further down into the climate risk element of that. Environmental risk are much more broader than just climate risk, of course, right? There are other elements here. But in terms of the stress testing focus that we see from regulators around the world, it is really these days on climate change. Now, the last decade has seen increased regulatory attention around the world, starting in Europe with the Bank of England and the European Central Bank, really focusing on this. But we're now seeing regulators across our region here embedding and defining new stress testing requirements and starting to increase, slowly but surely increase the expectations, right? So we have seen now HKMA in Hong Kong, the MAS here in Singapore, and now Bank Negara as well with the draft exposure with the draft for climate risk stress testing that came out earlier in the year. So where does this fit into the broader context? Let me start there here on this slide. The first step here is, as Junaid also pointed out, is the overarching high-level commitment, right? Whether that's a net zero commitment by 25 or something similar. We then need to take a look at the risk and opportunities that we face at the back of that, right? And the starting point here is a consideration of various climate scenarios. And we heard a few named already, the RCPs, which are expressions of a combination of forecast and potential pathways that incorporate reactions and actions by governments and the private sector to that. And there's a broad range of scenarios and different sources. I don't want to go into too much technical detail here, but roughly they're looking at the strength of the physical risk elements, right? And obviously the longer we wait to do something about climate change, the more extreme the impact of those climate changes will be on physical risk side. The faster we react, or the more suddenly we react and change the way we live our lives and our economic systems, the stronger the transition risks will be, right? Because they arise from sudden changes in our economies and the way that we price in climate changes and change our energy mix and consumption patterns. So that's where the starting position is. We have a number of scenarios and we need to choose which ones are relevant for us that we want to test. Some regulators increasingly define those, right? The Network for the Greening of the Financial System, NGFS, has set out and is continuously updating a set of scenarios that become more or less the standard for regulators to look at. What then needs to happen is we need to transfer this and translate this into various variables, right? And what I mean by that is this could be macroeconomic variables like GDP impact, unemployment, etc. It could be financial markets impacts, interest rates impacts, equity price changes, etc. We have direct and indirect physical risks that we need to take a look at, transition risks, litigation risk and insurance specific risk. We heard both from Irina and Junaid before how those link to the broader climate risk. The key point here is the different scenarios will show us different pathways for all of those, right? And then as part of the stress testing, we then need to quantify the impact under different scenarios, different assumptions, and those different variables. How can we use the output of that? Well, these can inform management actions, right? Changes in business mix, changes in product mix. Do we want to change our interaction with certain industries, with certain sectors, exclusions, or engagement strategies with certain parts of our customer base, right? That has an impact on risk management. We heard the 3 lines of defense as they implemented in the AIA before. That involves some climate risk strategies. How do we mitigate the negative impacts? How will this change our investment strategies, our strategic and tactical asset allocation in order to achieve our overall climate targets, right? And then we get into the whole metrics and disclosure part that Arena talked about before. So on the next page, if I go to the next page, I don't want to go too technical here, but again, what do we need to do here? We have these scenario pathways that define a possible future. They don't tell us this is exactly what's going to happen, but they show us a potential future under certain assumptions. And those assumptions typically include development of carbon prices or carbon taxes, right? A shift in the primary energy demand and the composition of where we get our energy from. It could be on the physical risk side, changing in weather patterns. That means changes in rainfall patterns, changes in sea level rise, changes in flood risk, etc. So then the second question, or the second step, is we need to transfer that into economic shocks. And typically for those, we employ macroeconomic models that link these climate scenarios into macroeconomic variables. Now, in some countries, like here in Singapore and in Hong Kong, the regulator will take such a macroeconomic model and do some of the work for you, and basically say, here's a certain scenario. These are the macroeconomic impacts that we want you to take and run in your stress testing environment, right? That you use for also purposes of your capital forecasting and financial stability forecasting purposes. The third step, and that's typically what existing models, stress testing models would already do. You have an economic scenario that will then impact asset value streams. That could be on the investment side, could be on the liability valuation side. Those are largely then dependent on things like how big is the carbon footprint of a given company, right? What are the asset level characteristics if you have a real estate investments, right? How much at risk from certain physical risk is the assets that you're investing in or the asset that you own? We heard about the example of branches, right? And then last but not least, the last step is then to turn this into a financial impact on your balance sheet, right? So this could be via say, looking at what the impact on value, when we're talking about equity market, or credit rating, when we're talking about credit markets, is for an individual counterparty like a company that you invest in, or it could be to the value of the asset, right? If you say you have real estate investment, that value would be impacted because of the higher physical risk that you would expect for that asset. Now, one of the challenges here is there are a lot of different ways of modeling this. There is not one way yet that is established doing this. Different vendors, different advisors, and different companies will have different ways of doing that. It doesn't help that the regulators are pursuing slightly different approaches as well. So we're still in a mode of flux, at a state of flux at the moment, where the regulatory expectations are evolving, the data landscape is evolving, right? And thus, what we see insurers do is really do an iterative approach, a learning approach, right? But you got to start somewhere, and that's what I'm talking on, about briefly on the next page. And really, where we can start, right, at the first stage is to really map out what the transmission channels are. And I like the example that Junaid brought, you know, the picture about the human health and how this is impacted. That is really a starting position to ask yourself, what are the different elements of our climate scenarios and how could they impact the normal risk drivers that we look at as an insurance company, right? So if you're a property insurer, that's a little bit more straightforward. If you're a life insurer, it's a bit less straightforward when it comes to quantifying those risks, because as we heard already, there is a lack of data to do that analysis. So give you one example, right? We know that with increasing temperatures, right, the risks of heat strokes will increase, right? Now, that there's a non-linear function, right? Because it really depends when we hit certain wet bulb temperature limits, right? Where suddenly we have a cliff edge effect, and we see an increase in health impact, particularly if you have a population with underlying cardiovascular risk types, right? But that's a non-linear function. Now, the challenge is already for insurers to actually map historically the impact of previous heat waves on their excess mortality and morbidity, right? Even if we have that data, right, to then overlay what would be the additional impact from increased climate change risk is then the additional challenge, because that is location specific. A lot of this is dependent what other measures we can take as a society. Just speaking of air conditioning, for example, is another overlay, right? So it really, really quickly becomes a very complex modeling exercise that, frankly, we haven't sorted out yet globally. Right now, what is interesting for the Bank Negara guidelines is that they do expect you to take a look at liability risks and as much as possible try to assess the materiality. So where you should start for sure is do a qualitative scenario assessment there, map out the transmission channel, understand what are the relevant risks for your portfolio, conduct an exposure analysis, and then look at what are the different scenarios that might be important for you, right? Before you actually start trying to quantify the impacts under the different scenarios. Now, why is this all very difficult to do? I mentioned a few things, but on the next page, I've summarized a few more. Data is a challenge both on the liability and the asset side. Let me start with the asset side, right? For the asset side, it's really how will climate change, so the transition and physical risk, impact your investment returns, ultimately, right? Now, most insurers do not do that directly, right? You rely on third-party asset managers to do the investment. So there is a bit of an arm's length challenge here, right? Challenges of inconsistent kind of reporting practices, and also levels of sophistication by the asset managers in terms of what data they can provide in terms of climate impacts. On the liability side, we talked about this different data challenges. So with all of that, right, we need to find a way to incorporate different data sources in the future from different data vendors, different asset managers, and find one consistent way to bring this all together to allow our internal reporting, metrics on top of that, and then the impact assessment, right? So let me conclude again. This is all an evolving practice, both for the regulators. They're tapping into this right now. They expect to increase their requirements over time, right? And the complexity of their stress testing. Data is the main challenge. It should not hold you back from getting starting on this process, if only with qualitative assessments, right? So with that, I'll conclude my part and happy to take questions as we go into the Q&A later.
Thank you, Wolfram. That's good sharing from the background ASEAN side, where we see, a lot of insurers are taking a pragmatic step. Now, next up we have is Mr. Marcel Omar Pap. And Marcel is the head of Re-Takaful at Swiss Re Malaysia since 2009. He is also the representative of the General Insurance Association of Malaysia in the Malaysian Sustainable Finance Initiative. So prior to moving to Malaysia, Marcel was based in Hong Kong and Singapore in various underwriting roles, including head of casualty treaty desk and product manager casualty for Asia. So maybe Marcel, over to you for a short sharing before our panel.
Okay, Assalamu alaikum, good afternoon. Thank you for the kind introduction. So in my presentation, I will focus really on the flood risk and the role of reinsurers and reinsurers can play. So next slide, please. When I woke up this morning, I really felt like the floodgates are open here in KL. It was raining very hard. So, and as I think all of the participants know, next slide, please. This is not a unique occurrence. I mean, Malaysia has been hit by severe floods in the past few months, not only here in KL and Shah Alam, like the one in December, but in other states such as Pahang, as I'm shown on this. Next slide, please. However, this is not specific to Malaysia. If we look now a bit wider, and Iqbal has mentioned it as well, the severe floods in Pakistan, they happened this year. So the figures I'm showing here are from last year. So last year, Asia was also very badly hit by floods. You see overall total economic losses in Asia last year from natural catastrophes was about 57 billion US dollar, out of which was 32 billion from floods. And if you look at insured losses, 8.3 billion, 3 billion from floods. So a huge amount. And as you can see, there is still, as Arina mentioned again, already there is a big protection gap in Asia. Last year, it was about 49 billion US dollar just from nat cat events. Next slide, please. Even if we look globally, we see an increasing trend in flood losses. If we compare the 10-year period between 2001 and 2010 and 2011 to 2020, you can see insured flood losses have actually doubled, with the Thai floods being the biggest one in 2011, costing about 18 billion US dollar. So clearly flood is becoming an increasing risk. Next slide, please. So what are the reasons for that? Naturally, climate change is one factor, but it's not the main factor. I mean, first of all, there is a significant economic development in the whole region. There is a concentration in exposed areas is getting bigger. You see here the picture on the left side of Shanghai comparing 1990 with today. You see the big change. Naturally, people like to live by the seashore or by the river. So the exposure by this is naturally increasing significantly. And also with increase in economic wealth, people are also more able to afford to buy flood insurance, which again in turn increases flood insurance losses. And finally, with urbanization, soils are being sealed, so water cannot run away. So this increases the likelihood of flash floods, which we have also experienced in KL earlier this year. The next slide, I think we can leave aside. Let's move to the next slide. So the question then is, we have seen flood losses are increasing in the past 20 or 40 years, but how will the future look like? How will the future, the exposure from floods be in future? And let me say a few words on that. Next slide, please. Definitely, this is also a question the regulator, in case of Malaysia, Bank Negara asked. ask the insurance companies to take into consideration the effects of climate change on their own portfolio, like with the climate risk management and scenario analysis, the exposure draft, where companies will be forced to analyze how their portfolio is exposed from climate change. And here analytics can help. So Swiss Re has developed some methods to do this analysis, the effect of climate change on the physical risks such as flood. This helps first to identify the different hazards which will evolve as a result of climate change, then to measure which segments of the portfolio are most vulnerable to climate change effects, then to monitor and steer the portfolio and manage the accumulation, and finally also to implement mitigation actions considering the impact of climate change. Let me give you an example how this looks like for Malaysia. So next slide, please. There is this so-called climate risk score, which looks at 9 different hazards, which you see on the right side. I mean, not all of them are naturally relevant for Malaysia, but the most relevant are flood, drought, and sea level rise. And then various climate change scenarios or pathways are being looked at, as already mentioned also by Arina. There is the business as usual path, which is also called RCP 8.5, up to a stringent pathway where, in a way, the Paris Agreement measures are fully implemented, and by this the temperature will remain below 2 degrees centigrade. So then all these hazards are considered, looking at these various pathways, and then a climate risk score is given between 0 and 10, naturally with 10 being the most severe. And if the climate risk score is between 6 and 10, then the impact is major. If we move to the next slide, you can really see the impact, how it develops for the 2 hazards of sea level rise and flood in Malaysia for the next 65 years. You can see which areas are mostly affected. Not surprisingly, it's the west coast of Malaysia, but naturally also parts of Sarawak and Sabah, which will be affected in the coming years or coming decades, I have to say, from sea level rise and flood. And the expected losses, naturally, there is a lot of uncertainty, but can increase by 20 to even more %. And if we move to the next slide, if we then consider urbanization and the expected population growth, especially in coastal areas, the impact is even much more severe, as you can see here from the graphics. So we have actually, next slide please, done, here you see you can move to the next slide. We have actually recently done an analysis for major insurer and takaful operator in Malaysia and calculated the impact from climate change on their current portfolio. And for example, based on the various scenarios, we expect actually the expected losses from floods to increase by 15 to 65% by 2050. And if we take into consideration the trends in population growth, this adverse impact even increases by 1/3 more. So this shows that really if we look a bit further ahead, not only a few decades, the impact can be quite severe. And so the question then is, what role, next slide please, insurers and reinsurers can play? Thanks, yeah. And here, insurers, reinsurers can play an important role in three ways. One is really to assess the flood risk rigorously. And here is really to push for better data quality. I mean, Wolfram has already mentioned that data quality is a big issue. Naturally, even with regards to flood risk, data is not always that well available. Here, really, the industry has to push for better data quality and transparency, because this makes it sure that the industry is actually better prepared for the increasing risk from floods. The industry should also use existing flood hazard and modeling techniques to strengthen their capability, their model capabilities, because this in turn will improve the flood pricing adequacy and also lead to better accumulation control of their own exposures. Finally, a robust and trusted risk assessment is a further key to maintaining and advancing flood insurability and to avoid surprise losses as the one we experienced last year. And furthermore, it's important to improve the communication of the flood risk realities of the different locations within the industry and also with other stakeholders such as the government, to help design more effective mitigation plans against flood risk. The second way how the insurance industry can help is in closing the flood infrastructure gap. Huge investments are actually needed to keep the structures functional and or to retrofit infrastructures that they remain effective against increasing risk from floods. Traditional, what we call gray infrastructure, protects against the fury of water, but at the expense of biodiversity. Green infrastructure helps restore the natural water retention capacity of the landscape, for example, through engineered floodplains. This construction of green flood protection system naturally brings risk both in the construction and operational phases, and there insurers can support by offering cover against risks associated both in the construction and operation of such protection systems. Finally, I think one of the other key role is really to close the flood protection gap. Arina has already shown that there is a huge protection gap. Even in Malaysia, if we look at the Shah Alam loss, it's estimated to be about 6.5 billion ringgit, and only half of it has been insured. So there is, even in Malaysia, a big protection gap which needs to be addressed. One way is, for example, to develop bundled products with including flood cover, which typically show significant higher pickup rates. Then, as Arina mentioned as well, the development of parametric or in micro-insurance products which ease the burden from emergency expenses incurred as a result of heavy rainfall. And finally, the insurance industry should also design affordable and practical insurance products to transfer the risk from flooding. And these are all areas where the insurance can play a role. Yes, I think with this I can conclude. We can skip the last slide. Yeah, it's just a summary of what I have said.
Thank you, Marcel. I think that gives a very good insights on the advancement that Swiss Re is making, including Junai for AIA Malaysia as well. I think this has been very beneficial. Now, with that, I would like to, before we get into the feedback, I think it's more of let's get into the session for Q&A. We do see quite a number of questions coming up. But before that, I think before we take the questions from the floor, there are a number of questions that I'm also keen to first ask, if I may, for the key panelists that we have here. So given the first part that we have actually seen, the first part we're talking about is, Junaid, you've shared the insights on this, but we also want to understand that given the current challenges that we are facing, Junaid and Marcel, and given the initiatives of Subcommittee 5 at the JC3 on data management, where do you envisage the alliances, or at least the synergies, can be driven from the local players, at least for Malaysia as a start? Maybe Marcel, Junaid, either of you could take on the first part.
Yeah, let me start first, Junaid, and then feel free to add. I think here we have some very good examples from other countries. For example, the general insurance, I don't know the exact name, in Australia. They provide, for example, very detailed statistics about natural catastrophe losses which affect Australia, where an independent party collects industry data and publishes. It's publicly available for anybody. And I think that would be a great thing which Malaysia could start doing. I mean, in Australia, it has been done for the past 40 years already. Malaysia is actually an independent party already collecting insurance data, but it's more on the premium side, Insurance Services Malaysia, which is actually run by the three associations, MTA, PIAM, and LIAM. So actually ISM could also collect data such as from past flood events and other losses naturally on an anonymized basis to follow PDPA requirements, and then start collecting this data and also publishing it, because it's important also even to make the public aware about the role insurance and Takaful plays. So I think there industry-wide a lot could be done with such initiatives.
Thanks, Marcel. So maybe I can just add, under JC3, there's a data needs working group that was set up. And as an industry, you know, the financial institutions all got together and basically listed out what the data gaps were and then how to fill them. So it's again laid the foundation for, you know, filling in, at least identifying the gaps first and then figuring out a way to fill them in. As some of you might be aware, we also have a climate change and principles-based taxonomy that was released by Bank Negara, and we were required to do the first CCPT classification as of the half-year mark this year. And even for that, you know, what we realized was that to classify economic activities, which for insurers or life insurers meant primarily investments, it meant looking at company disclosures to go through, you know, whether the activities that they undertake are mitigating or adapting in terms of climate change. So disclosures from a company's point of view are very important. And we also see that the climate risk exposure draft that's come our way will require disclosures in the future from 2024 onwards. Companies that are listed on Bursa already, I believe, are required to do, you know, sustainability-related disclosures anyway. So I think a strong foundation is in the process of being laid right now, but there's a lot of data gaps to fill in the future collectively as an industry. Yeah.
I think that's helpful. We are all aware that in Malaysia we're not as we don't have a coordinated platform at this point for emissions data, and quite a number of the physical risk data are also at various sources at different granular detail. So definitely there's a need for the government regulators as well as the public to actually come together to really have a certain level of synergies of the data. Otherwise, it will be quite a fatigue. If I put it simply, to gather some of this to develop a very good scenarios and stress testing, as what Wolfram has mentioned as well. The key challenges is essentially having credible, good data. So maybe I'll transition from here to Wolfram. When it comes to the journey, and you have shared what looks like in terms of those who are in the nascent stage and moving towards the advanced stage when it comes to the integration. Now, based on your experience, what are the good lessons learned from those who are in the initial phases and looking to advance further? So maybe I'll pause there, Wolfram.
Yeah, I think a good start is with the taxonomies and understanding, right, how to classify the different parts of your book, right, and understanding what you have. You need good support from the top down, right? So a strong key stakeholder support, and we heard that again, I think from both panelists here, how that works out in some of the industry examples, right? So good leadership, a good tone from the top, both in the sense that this is not just about risk mitigation, right? But this is an economic opportunity, and one that will be pervasive in everything that an insurer does, right? In terms of own operations, in terms of the services and products. And I think one of the things that we increasingly see in our discussions is that, or the questions that we get is really about the upside. Right, people understand that this is a risk, that we need to have a handle on this, and we need to understand how that might hit us on the investment side or on the liability side. But increasingly, right, the question is, how can we be green without going into red, meaning without writing losses, right? And that's a tricky question, right? Because depending on the customer segment, while there is, many customers will say they're interested in green, when it actually comes to the dollar and pence, right? It's still difficult to price differentiate for that, right? Because particularly in the retail space, and we see this globally, the willingness to pay extra for green products is not quite there yet, right? So what we need to have is a discussion in the organization while we're doing this. How do we link this back to our corporate mission and strategy? How do we actually create value from the investments into this? Not just from a risk avoidance perspective, but from other positive effects, and some of those are less tangible or a bit harder to quantify, but they are very real. Is anything from your from staff retention and development to the public image and brand development of the organization, right? It is customer retention, right? That you're seeing to walk the walk and not just talk the talk. And then ultimately, it goes into development of products. And yourself, Irina, you gave some examples, and we actually have two prominent companies here on the panel who are part of this product innovation, to find new ways to link the outcomes from behavioral changes to insurance rates. Right, so this is certainly a very interesting area, but certainly one where we need to see a lot more innovation, particularly here in APAC. So I think having the starting conversation about both the risks and the opportunity to understand from the top down, why are we doing this? I think that is the key starting point that gets the ball rolling the investment dollars that you need, right, to make a tangible change in the organization.
Thanks very much. I think that helps to align where we are seeing. Okay. Interestingly, we have question that is pivoting to an area which is a hot topic right now. Now we know in the transition risk, government has also introduced or announced the carbon tax in the recent budget. Their initial plans, although we know the parliament has been dissolved, but any use case in this impact on insurance companies in other countries that has similar carbon tax? I think this is really tapping on Marcel, Junaid, from your views, lessons learned from the carbon tax in Singapore, as well as the carbon tax that has been also announced for Indonesia. How do you see that has affected the way you looked at carbon tax as a transition risk?
Well, simply put, right, maybe I'll start very quickly with the stress testing point of view, right? Simply put, carbon taxes or carbon prices are one of the key modeling driver in the assessment, right? Because that really is a cost line item, right, that impacts the financials of companies directly. And depending on the level of, how much of that cost they can actually transfer to the ultimate consumer, right, it also impacts on individual consumers as well, right? But that's pretty core part of the stress testing, and understand the impact of the various transition scenarios. Now, the challenge here is in most markets, right, the carbon taxes that we see, or the carbon prices, are still way too low, right? We can see how they will rise in the future. Some markets, like in Singapore, have already forecasted a relatively steep rise in the coming decades. But still is way lower than even what other countries, like for example Sweden, have implemented already for a while, right? So there's a huge range in terms of the carbon prices that we see currently in the market, and what will be necessary to achieve certain carbon outcomes. And that's really the variability that we need to play with in our scenario analysis. So let me stop there and give enough room for the other panelists to talk about this.
Yeah, Junaid and Marcel, if you could cover also your views on the subscription to various avenues to actually get carbon credit to offsets, that would also be helpful as part of your consideration to net zero strategy.
I mean, shall I start, Junaid? Yeah, I can only, on the carbon tax, I can only echo what Wolfram has already said. I think the levels are still very low compared to what is required to have any impact globally. Whilst they are much higher in Sweden, even there, I think they are still too low to have real impact.
Yes.
Let's leave this aside. So therefore, I don't see it will have in the near future any significant impact. Now, talking of the net zero and the carbon removal, I think we have to differentiate here between the fundamental difference between carbon offsetting and carbon removal. Because a lot of companies are still doing the carbon offsetting, where they still have the existing pollution. So really, to make an impact and to reach net zero, you have to do carbon removal, like through new technologies, like direct carbon capture. These technologies are still nascent, but it's something you have to, otherwise it's no way you're going to achieve the Paris Agreement goals of net zero by 2030. I mean, for example, I can talk Swiss Re. We have now started to invest into direct air carbon capture companies which are developing this industry. And even as an employee, I can invest money for my carbon footprint, which I personally do. I can remove this through carbon capture action. So I think that the two should not be confused, the two. And really the way forward is try to do carbon removal rather than just offsetting.
Yeah, that's good too. And any add-ons, Junaid, or I can go to the last question.
I think the experts have covered it already, but I echo what Marcel said. So carbon neutrality and net zero are used sometimes interchangeably, which is not the right thing to do. As Marcel said, neutrality means just you have a carbon footprint, you offset with something else. And net zero basically means, especially if you've signed up like AI has for the Science Based Targets Initiative, it actually means you bring down your carbon emissions all the way very close to zero. And then there's a certain amount, a very small amount that you can then offset at the end. So yeah, this one.
We under the MSFI, some of the workshops we've also covered the distinguishment. So for those who wants to understand further on some of these areas, there are very good upcoming workshops that's going to talk about this. And we have a last question, but before we get there, maybe I can get the team from MSFI to put up the poll link to get your feedback. Then we head to the last question. If you can also put your feedback, much appreciated. We hope the sessions has been great and useful to move the needle within the industry sector. So the last question is a very unique one from our attendees. So very first is thank you, the panelists, for a very insightful session. Now, what we have seen is a lot of the team today is mainly anchored on ESG integration and adaptation for underwriting and so on and so forth. So the key question is, are there also focus towards climate mitigation side? It has been sort of mentioned to some extent in the project level financing and investings as well. But there isn't a twist to some of the questions. So one of the part I would pinpoint clearly is there is a recent decision for context-wise. Munich Re has announced that they are going to exceed or exclusively get out from the financing from 1st April 2023. They will no longer invest or insure in the construction operation of new oil and gas fields, new midstream oil infra, and new oil-fired power plants. So with these direction from Munich Re, I guess the key question is, what are your thoughts when it comes to this direction? So it is somewhat in your view, but I know it's a very tricky question, but it's good to have views and context as well. So unfortunately, I have to raise this question. So maybe Marcel, Junaid, any thoughts?
Yeah, okay. I think I can say Swiss Re is ultimately going in the same direction. I mean, we have also a thermal coal policy in place. I think here really the aim is to work together with the affected industries and help in the transition. Maybe not right away, not to write. However, it's important to see that these industries are willing to take actions. I mean, and here this is the important role of the insurance industry to work together with such companies and to make sure they are going in the right direction and then help them in their transition. Because within all these industries, there are differences how companies approach it. I mean, not only in the oil and gas, but also relevant for Malaysia in the palm oil industry. And we should encourage companies who want to transition to the greener economy and support them.
Thank you, Marcel. Oh, Junaid?
Yeah, maybe I can just add that for AI, so we have to be cognizant of our area of influence, right? So our as a very large life insurer, we have over $300 billion of assets, and we can determine whether they're going to green causes or not green causes. So we've actually made a call, and we've fully divested from directly managed listed equity and fixed income exposure to coal mining and coal-fired power businesses. and there's no new investments in this either. On the live side, it's not as clear-cut as funding, like on the general insurance side, okay, if you're funding a plan that will facilitate coal-related activities, I understand Unicre's approach, but on lives that are working and insuring them for sickness, etc., this is something that the industry still, is trying to get some direction on what the right thing to do is. Yeah.
All right.
Yeah, there's also interaction with other risks, right? That we have seen now with the episode in Texas, right? There might be political backlash against such decision by individual investors and asset managers, right? So there's a political dimension these days to that. That might turn into litigation risk, right? Or at least brand impact in some parts. There's a question, by doing this, right, are you actually increasing transition risks in the short term, right? So there is an adverse effect from that. So I completely subscribe to the point, right, that Marcel said. It's more about engagement, right? Now, of course, selectively exiting industries that will continue, and that's the long-term trend. Otherwise, we cannot get to net zero worldwide. That is clear, right? But the way we go about this and get there, that is the key question, and engagement is a key part, right? And considering the possible adverse impacts on other risk as well.
All right. So thanks, Wolfram, Junaid, Marcel. I think this session has been great. We've received very good feedback. Maybe I'll pass back to Navina to close this.
Thanks very much, Arina, and thank you to Wolfram, Junaid, and Marcel. This was a great session. Ladies and gentlemen, thank you for tuning in. And as we mentioned earlier, if you'd like to be updated on MSFI programs, please do feel free to follow us on LinkedIn, where we will post other programs that are coming up. With that, thanks again, and have a great evening, everybody. Bye.
Bye-bye.
Thank you. Bye.